Hey everybody, this is Aaron Clary here, and like my previous video, retirement planning in under 10 minutes, even though the video was 11 minutes and 30 odd seconds, the presentation itself was under 10 minutes. Want to put together a very quick video because, again, we're going to operate from the premise that financial planning and investing and all that is very intimidating, but if we teach you a couple of quick tricks, you'll do something which is better than nothing, unless you do that something very wrongly, in which case, yeah, you totally screwed it up. So what we're going to do is show you how to analyze a mutual fund. And you have two ways to do it. One, you can go and look at the individual stocks and bonds that compile the mutual fund. And sometimes you have hundreds, 200 or more underlying stocks that compose a mutual fund. And you just don't have time for it. Frankly, I don't know how the mutual fund managers have time for it either. But thank God this company called Morningstar, and we'll go there, Morningstar.com. Morningstar, they came out back in the 90s, I think it was, back in Chicago. And you all should, everyone should be very thankful for this company. They did the Lord's work in terms of being able to analyze mutual funds. Now, obviously, you can take a look at many other things. But what you're going to want to do is you could search for a mutual fund here. But if you have the ticker symbol, we're just going to use Vice X because that's my favorite mutual fund because they invest in sin, like Vice. So you type the ticker symbol, it always ends with an X. And there you go. It pulls up this. And there are many variables that you go ahead and analyze. What I do is I look at three. I certainly look at more, but I'm saying these are the main three I look at. And is what I'd recommend you take a look at too. One is the star rating. I know it's simplistic. It's from 0 to 5. 5 is the best one. 0 obviously the worst. And if you want to do the quick and dirty, go with the highest star rating because it incorporates all these other different variables into one. The next thing, and I say this is even more important, is you want to take a look at whether or not this mutual fund beats, quote-unquote, the index. And I'll explain the index very quickly. The index, like the S&P 500, the Dow Jones Industrial Average, every type of mutual fund has a benchmark or a performance measure that you compare its performance against, and that's called the index. And the index is great because last I checked, 85% of the investment professionals can't beat the index. So this brings up a very important point, probably the most important point about investing, and that is, if you can invest in the index, then why would you pay somebody to manage your money for you? The index beats 85% of the investment professionals, or historically has. So in just investing in the index without having to get your bachelor's or master's or doctorate in finance or investing or whatever else, you're going to beat the majority of those schmucks over in Wall Street by just investing in the index. So now if you're going to pay somebody, because you do pay when you invest in a mutual fund, you are paying for these people to manage your money and invest and do the research. It's only fair. They got to make money somehow too. They don't do this out of charity. If you're going to pay somebody to manage your money, then they damn well better beat the index because you can match the index. So if you're going to pay for them, they should be beating the index. Now, there are going to be three colors here. One is this darker blue color, and that's the actual mutual fund. You can see that performing there. And then the other is the orange one. It says large blend. It isn't always going to be large blend. The reason large blend is listed as such is because that is the respective benchmark that Morningstar has assigned to this particular mutual fund. And you want to compare it to the orange line or the established index because different mutual funds have different composites of, some have 80% stocks, some have 20% bonds, some have 80% bonds, some have 20% stocks, some have commodities, some have rental property, all these other different asset categories, and in varying proportions means there is no one universal index. Now, we always throw in the S&P 500 right here. That's the most comprehensive equity or stock index out there in the United States. So they just throw that in there for reference. But what you want to do is really compare the blue line against the orange line. And you see that, sometimes it's underperformed, it overperformed, then it underperformed, and they were back on par, and now it looks like the Vice X, the mutual fund, is outperforming both the S&P 500 and its respective index. So that right there for me is the number one thing I would look for. But again, the quick and dirty here. Then finally, what you want is the expense ratio. So you click on expense, and I'm sure they're going to have many, many other metrics. Here we go. The expense ratio. Again, they kind of show you a category and the mean and median, all that other stuff. I just have a general rule of thumb that I like an expense ratio of under 2%. You get above that, that's getting a little pricey. So for me personally, this would be all right. You may want to compare it against the average and the mean, but that's just, again, the quick and dirty. You want an expense ratio of under 2%. So anyway, that's it. That is all there really is to it. I hope that helped everybody. And remember, you can always go and take my online investment classes. We have a basic introductory one called Stocks, Bonds, Investing OMI, and another one that's more advanced called the Analysis and Valuation of Stocks. Both you could find online by searching them. They're offered through many community education programs and various colleges and other kind of nonprofit educational institutions. And obviously a lot more thorough than what we're doing here. But again, this is just the quick and dirty. And now you know enough to be dangerous. So go out and be dangerous. Toodles.